This video is just an introduction to stocks. I'm not going to do a ton of stuff with it, but what you do need to know about a stock is that when you purchase stock, you are actually purchasing a part ownership of that particular business. So here is a share of Microsoft stock. It is one share, which means you have a part ownership of one stock out of millions of stock. So the pros and cons, and there are more than these, but these are the only ones that I expect you to know for this. The pros of owning stocks is that, once again, you are an owner of this business. So if Microsoft makes a profit, they are going to pay you money, and it's based on the number of stocks that you own. So we will look at a stock table, and if Microsoft is paying $2 a share and you own one share, you're going to get a check for $2. If you own 1,000 shares, take 1,000 times 2, you're going to get $2,000 in a dividend. And we'll do some math handouts with that. The other pro is the idea of capital gain, and that's what people do when they buy stocks. Their goal is to buy it at one price and sell it for a higher price. So the difference between the buying price and the selling price of a stock is either a gain or a loss. So if you bought it at 10 and sell it for 15, you made $5. That was your capital gain. If you buy it for 10 and sell it for 5, you have a $5 loss. That's your capital loss. Trading, you need a stockbroker, and so you will call your broker and tell them you want to buy stocks or you want to sell stocks. And they will go to the exchange where that particular stock is sold, and they will either issue a buy order or a sell order. And so the most famous stock exchanges is the New York Stock Exchange and the NASDAQ. So you have to figure out, which, well, you don't, but your broker will figure out which market that your particular stock is being bought and sold on. And there are more than these, just these two. These are the most famous, where most of your larger, more recognizable companies are going to be traded on. Measuring a stock performance. On the bottom there, you have bull versus bear market. So if you're listening to the news and they're talking about a bull market or a bear market, and I like this little illustration, that's why I put this on here. It says bears swipe their claws down. So if you have a market, and if you look to the right, you can see it going up, and then there are places where it goes down. So in times where you see rapid growth, and I hate to be so specific right now, but since Donald Trump entered office last November, we have definitely been seeing a bull market where the market is just continued to rise and rise and rise and rise and rise. And so they would call that a bull market, because the market, which is the value of most of the stocks that are being traded, are on an upward trend. So we've seen huge increases in the stock market. And for it to be that, it has to be over a period of time. So if you see a slump one day, we're not going to say that's a bear market, but a bear market is where you see continuous selling off of stocks for various reasons. So a bull market is where we see an upward trend, and a bear market is a downward trend in the market. This is the Dow Jones Industrial Average, and here in a second we will look at the stocks that are traded on that, and we'll talk about their significance. But this is a measure of the performance of the stock market. So what this is saying is we're going to take 30 different companies, and we are going to measure what they're doing on any given day. And if those 30 companies, those blue chip stock companies, are doing well, then we can assume that the overall performance of all companies are okay. If those companies, those 30 companies, are not doing well, then we can assume that no one is doing well. And then the S&P 500, that's another one that you'll hear on the news. That is another average of 500 different stocks. So the Dow just measures 30 stocks, and those are the blue chip stocks. The S&P 500 is a measure of 500 stocks. And if the average of all of them or most of them is going up and they're doing well, we can assume that our economy is doing well. And so here is a list, and this is as of 2015, but the list is still the same. None of these companies have come off or been replaced by a different one. So if you look at the names of these companies that our Dow Jones Industrial Average is calculated on, 3M, American Express, Apple, Boeing, Caterpillar. I don't want to read them all, but you've got Walmart on there, Disney, Verizon, Visa, Nike's on there, McDonald's, Home Depot. Sorry about that. If these companies are doing well, which they normally do, these are name brand products that everyone purchases, then every other stock is probably doing well or relatively well. If you see Walmart struggling or Exxon struggling or Coke struggling or Boeing or Microsoft, Nike, if these companies, McDonald's, aren't doing well, then we know something's wrong with the overall health of our economy. So the Dow Jones is that average that you see reported on the news every single night. If you turn it on certain channels during the day, it's reported on the corner all day long. People are watching this because they want to know. Even if I don't own any stock in this particular company, if I have money in the stock market and these are doing okay, then I'm probably okay. If these companies aren't doing okay, there's probably something bad going on, and my investments are also going down.